Terry Smith runs Fundsmith Equity, which is one of the most popular funds among UK retail investors. After a strong run for the fund since launch, 2022 saw Fundsmith record its first calendar year of negative returns as it got caught up in the big sell-off for the type of growth companies that sit in its portfolio. Terry Smith is with me today to discuss the fund and his thoughts on the current state of the portfolio. A lot of investors have asked, did you not see this coming with regards to central banks pushing up interest rates and how that would negatively impact valuations and share prices for quite a lot of companies in your portfolio? I think many investors might have expected you to try and protect their money, not sort of let it slide because of the shift in the market environment. What do you say to that?
I would say that they probably should read what I've been writing for the last dozen or so years, which is we've said we will not attempt to time the market. We will always be fully invested in companies of the sort that we describe. And if they want to try and time the market, they can knock themselves out. They can buy and sell our fund every day at noon if they want to, and go ahead. And we've been crystal clear about that. We're not going to do that because we don't think we can do that. We don't think they can do it either, by the way. But they're of course it's their money; they're entitled to try. When they say, "Didn't you see this coming?" Yeah, but I mean, there's a great sort of statement which I can't remember the exact wording of, but it came, I think, from Ken Fisher, the fund manager, and he was talking about style rotation because he had a style rotation project, which is rather topical in this regard. And he said the problem with forward indicators of markets is that they will help you spot 10 of the next 3 bear markets. And it's kind of, yeah, well, how about if we'd gone in 2013 when the Fed started withdrawing its bond purchases and we had the taper tracks and went, that's it, we've gone to a very large piece of cash there. How would that have gone? And why did we know that 2022 was going to be the year where this would particularly work and not 2013 or some year in between? I think trying to manage money on the basis of predicting macro events is something which very few, if any, people are able to do. And it's certainly, most importantly, and I think this is important in offering a product, an investment product, is to say quite clearly what you are going to do and stick to it. So people have a high degree of certainty about what they're buying. So if they buy into us, they go, well, it's a quality growth kind of upfit emphasis with very little dealing, et cetera, and valuation as a secondary consideration. Hopefully, they shouldn't be all that surprised. That's the most important aspect for me.
If we're no longer in an era of cheap money, which arguably makes it harder for a growth fund to thrive, do you intend to have an even greater focus on valuation when you pick and review your investments?
Dan, I mean, you'll find in asking me questions, one of the things I might do is query some of your assumptions. And if we are in this area of less easy money, and it will make it harder for growth companies to outperform, really? What are we basing that on exactly? 1 year, 2022? Because we kind of like to deal in facts, we think they're quite important, really. We went back to have a look at how these things work. And we went and took both our portfolio and our investable universe, and we took it back for quite long periods of time. In particular, one of the periods of time we took it back for was the period 1980 to 2021. And the reason we took our portfolio and the investable universe is obviously that's very particular to what we do. But also, one of the problems of trying to use Bloomberg data for things like the growth sector versus the value sector versus the market is the data doesn't exist before the mid-1990s, so you can't get back to periods which are like the one that we are maybe currently moving into of less easy money. So we looked at 1980 to 2001 as a period when basically rates were averaged above, the Fed funds rate averaged above 4.5% during that period. That's why we chose it. And the reason we chose 4.5% is because that's what it is right now. So, this was a 21-year period when the Fed funds rate was above the rate that it currently is. So presumably it might to some degree reflect what we're moving into and live through. And I've got to tell you, our investable universe outperformed the index, and I'm delighted to say our portfolio outperformed our investable universe during that period. And we've got the data on it. I didn't do it in every single month, but it did. But on the average month, that's what it did. And it did across the whole period. And it did for segmented 10-year purchases. So the assumption that because we're in a higher rate environment, growth stroke quality companies won't outperform, might not be correct. It may, in fact, be sort of recency bias, I think, based upon 2022.
Okay. One of Fundsmith's mantras is do nothing. Now, your turnover in the portfolio 2022 is 7.4%. Some might say that's low compared to other funds, but perhaps it's a bit higher than some people would come to expect from Fundsmith. Now, I know you've got to sort of react to market and sort of company events as an active manager, but do you think the concept of do nothing is still relevant to Fundsmith in this sort of new economic environment?
Yeah, I think it's still relevant. Yeah, I think the turnover was 7.4%. We have had higher turnover than that. 2018 we had 13.4%. So that it has been higher than that. And the latest statistic I can get on OICS shows that the average portfolio turnover is 60%. So we're still pretty darn low out there. But I think what happened last year is that market events showed us that in a couple of cases with companies that we had to take some action. That we got to the point where the companies were, in our view, malfunctioning. We tried to engage with them to try and ensure that our point got across in terms of how the good business could not be ruined by the action that was taking place. We were ignored, and then there's only one thing we can do at that point, and that's basically pick up the phone to the dealing desk and say, get me out of here, basically. So I think events last year were there, but I don't think that there's been some fundamental change in the market. That means that the attempt to buy good businesses and hold on to them for long periods of time to let the businesses' returns do the heavy lifting of compounding is, for some reason, no longer appropriate. I mean, Buffett has run this particular methodology from 1965. With considerable success. So, and obviously from 65 through to recent times, you've seen some dramatically different market conditions: inflation, deflation, market crises of one sort or another, wars, pandemics. I think it's still valid. It doesn't mean that from time to time. I guess the analogy I would give you is events like we saw last year sometimes expose things in individual companies that are going there and make you have to think about taking slightly more action than you would ideally like to do.
Okay. I mean, I know that the fund obviously launched in 2010, and sort of inflation has only really been picking up recently. But what have you learned from periods of high inflation, across your career?
Yeah, I mean, look, I started work in 1974. My first full year in work was 1975. I started during the course of 74. And I can tell you the UK CPI was up 24.2% in 1975, or as we in the trade call it, a lot, right? So I've actually seen, if not this movie, a movie quite like this, a disaster movie quite like this before. And one of the things about inflation, I'll just say a couple of things about inflation. One is nothing's good, right? There really isn't anything good. I mean, you go, oh, well, bonds are bad, and that's fairly obviously sort of fixed income is not going to be very good. But equities are pretty bad too. And cash is not really very good either, is it, when you think about it? And gold might have been all right historically, and it might still be all right, but it's kind of pretty limited, isn't it? And we can obviously now rule out cryptocurrencies as an inflation hedge, not that I ever believed they were in the first place. So you're in one of those situations where, sadly, I think, from my experience, you end up making the least bad choice. And not only did I come into work and I had those experiences, running feet, we also saw this at work in a number of developing markets. We saw pretty high inflation in a number of the emerging markets that we invested in fleet during the period that we were running it. So we could see how it worked there. And actually, the least bad class is equities out of those, because obviously you do have the possibility of the return going up over time, which you don't have in your bond portfolio and you don't have in your cash. And the other thing about it is within equities, if you're looking for, equities in general, but the companies that you want are ones with high gross margins who are able to take a big markup between their input costs and their costs of sale, because that means when their input costs inflate, it doesn't have a big impact on their profitability. You're looking for people with pricing power, with leading brands and market positions who can at least pass on some or all of the inflation to their customer base. And you're looking for companies with high returns on capital employed. If you've got inflation running at 10%, it's better to own a company with a 30% return on capital than a company with a 10% return on capital, because one is making a real return, admittedly not as good as it was making when inflation was 2%, but the real return on your 10% one is gone, basically. So that's really what I would say I've learned from the history, both of me in employment, but also us running money.